Hi, and welcome to Finance Insider. Investing in the stock market can be a great way to grow your wealth over the long term, but it can also be overwhelming, especially if you're a beginner. In this video, we'll cover 7 important tips that will help you make informed decisions and reduce your risk. First and foremost, you need to understand that investing in the stock market comes with risks. The stock market can be volatile, and you can lose money if you don't do your research and make informed decisions. So, before you invest any money, you need to do your homework. Tip number 1. Do your research. This means researching different companies, sectors, and industries that interest you. Start by reading news articles, watching financial news channels, and following reputable financial experts and analysts on social media. You should also research the company's financial statements and performance metrics, such as earnings per share, price-to-earnings ratio, and return on equity. It's important to understand the basics of the stock market before you start investing. You should also familiarize yourself with the different types of stocks, such as blue chip, growth, and value stocks, and how they fit into your investment strategy. Tip number 2. Start small. When it comes to investing in the stock market, it's important to remember that it's a long-term game. Starting small can help you to manage your risks while you learn the ropes. One way to start small is to invest in low-cost index funds or exchange-traded funds (ETFs). These funds allow you to diversify your portfolio across a range of stocks and provide exposure to different sectors of the economy. Another way to start small is to set up a dividend reinvestment plan with a company that pays dividends. A dividend reinvestment plan allows you to reinvest your dividends back into the company's stock, which can help to increase your holdings over time. It's also important to remember that you don't have to invest all of your money at once. Consider investing a small amount each month or quarter, known as dollar cost averaging. This can help you to avoid the temptation to try to time the market, which can be a risky strategy. Tip number 3. Invest in what you know. Don't invest in a company or industry just because it's popular or trendy. Invest in companies that you understand and believe in. This will help you make informed decisions and reduce your risk. Investing in companies you know and understand can give you an advantage, as you may have insights into their performance that others do not. For example, if you're a technology enthusiast, you may have insights into the latest trends in the industry and the potential of new technologies. This can help you make better investment decisions. However, it's important to note that investing in what you know should not be the only factor in your investment decisions. You still need to do your research and analysis to determine whether the company's financials and fundamentals are strong and whether the stock is a good value at its current price. Tip number 4. Diversify your portfolio. Don't put all your eggs in one basket. Investing in a single stock can be risky, so it's important to diversify your portfolio by investing in a variety of different stocks across different sectors and industries. You can also consider investing in bonds and other assets that are less volatile than stocks. There are many ways to diversify your portfolio, but one common approach is to allocate your investments across different asset classes. This might include stocks, bonds, real estate, and commodities. By spreading your investments across multiple asset classes, you can reduce your overall risk and increase your potential returns. Another way to diversify your portfolio is to invest in mutual funds or exchange-traded funds (ETFs) that track a broad index or sector. For example, the S&P 500 Index Fund invests in the 500 largest publicly traded companies in the United States, providing exposure to a diverse range of companies and sectors. Keep in mind that diversification does not guarantee a profit or protect against loss, but by spreading your investments across a variety of asset classes, sectors, and companies, you can reduce your overall risk and increase your chances of achieving your long-term investment goals. Tip number 5, be patient. The stock market can be volatile, and it's important to have a long-term perspective. Don't panic if your stocks fluctuate in the short term. Focus on the big picture. You should aim to hold your investments for at least 5 to 10 years to maximize your returns. When it comes to investing, patience is key. This means resisting the urge to make impulsive decisions based on short-term market fluctuations or noise. Instead, focus on your long-term investment goals and stick to a disciplined investment strategy. It's also important to have realistic expectations when it comes to investing. While the stock market has historically delivered strong returns, it's important to remember that past performance is no guarantee of future results. It's important to focus on the long term and not get caught up in short-term market movements or noise. Tip number 6. Stay up to date on the latest news and trends. The stock market is constantly changing, and it's important to stay informed about the latest developments in order to make informed investment decisions. One way to stay up to date is to regularly read financial news publications such as the Wall Street Journal, Barron's, or Investor's Business Daily. These publications cover the latest news and trends in the stock market, as well as providing analysis and commentary from industry experts. Another way to stay up to date is to follow financial influencers on social media platforms like Twitter or LinkedIn. These influencers can provide insights into the latest news and trends in the stock market, as well as offering their own perspectives on investing strategies and opportunities. Tip number 7. Seek advice. Investing in the stock market can be complex and overwhelming, especially for beginners. Seeking advice from a qualified financial professional can help you to make informed investment decisions and avoid costly mistakes. For example, a financial advisor can help you create a customized investment plan that aligns with your goals and risk tolerance. One way to seek advice is to work with a financial advisor. A financial advisor can help you to create a personalized investment plan based on your goals, risk tolerance, and investment timeline. They can also help you to monitor your portfolio and make adjustments as needed. When selecting a financial advisor, it's important to choose someone who is qualified and experienced. Look for advisors who are registered with the Securities and Exchange Commission or a state securities regulator, and who have a track record of delivering strong investment results for their clients. Another way to seek advice is to join an investment club or group. These groups can provide a forum for investors to share ideas, strategies, and insights. They can also help you to learn from more experienced investors and develop a deeper understanding of the stock market. When seeking advice from a group, it's important to choose a group that shares your investment goals and philosophy. Look for groups that have a track record of delivering strong investment results and that are willing to share their knowledge and expertise. In summary, investing in the stock market can be a great way to grow your wealth over the long term. But it's important to take your time, do your research, and make informed decisions. By following these tips, you can reduce your risk and increase your chances of success. Thanks for watching. Be sure to subscribe to our channel for more tips and advice on investing and personal finance.